The Canadian Imperial Bank of Commerce, CIBC, presents an investment profile centered on compelling income generation and strong foundational earnings, balanced against a structural concentration of domestic credit risk. As of the third quarter of 2025, Q3 2025, the institution delivered robust operational performance, signaling effective navigation of the prevailing high interest rate environment, which underscores the security of its shareholder distributions. The investment conclusion for CIBC is predicated on a significant trade-off. The bank's ability to generate double-digit growth in its core operating segments and maintain superior capital adequacy offers substantial protection and warrants consideration by income-focused institutional investors. However, this positive momentum is continuously suppressed by a risk premium levied by the market due to the bank's substantial, localized exposure to the Canadian residential housing market. CIBC's reported net income for Q3 2025 reached $2.096 billion, representing a significant 17% expansion compared to the same period in the previous year. This strong growth momentum across core Canadian personal and business banking, CPBB, and Canadian commercial banking and wealth management, CCBWM, segments provides a clear indicator of operational health. Furthermore, the bank's Common Equity Tier 1, CET1, a crucial measure of financial resilience, stood firm at 13.4% as of July 31, 2025, remaining stable quarter over quarter. This ratio positions CIBC favorably, slightly above the estimated Q3 peer average of 13.3% for the major Canadian banks. Despite this capital strength, the primary constraint on valuation remains the $43.6 billion exposure in Canadian condominium mortgages, concentrated heavily in the rate-sensitive Toronto and Vancouver metropolitan areas. CIBC's reported net income for Q3 2025 reached $2.096 billion, representing a significant 17% expansion compared to the same period in the previous year. This strong growth momentum across core Canadian personal and business banking, CPBB, and Canadian commercial banking and wealth management, CCBWM, segments provides a clear indicator of operational health. Furthermore, the bank's Common Equity Tier 1, CET1, a crucial measure of financial resilience, stood firm at 13.4% as of July 31, 2025, remaining stable quarter over quarter. This ratio positions CIBC favorably, slightly above the estimated Q3 peer average of 13.3% for the major Canadian banks. Despite this capital strength, the primary constraint on valuation remains the $43.6 billion exposure in Canadian condominium mortgages, concentrated heavily in the rate-sensitive Toronto and Vancouver metropolitan areas. The market effectively assigns a discount to CIBC to compensate for this non-diversified domestic risk. Critically, the current common share dividend, set at 0.97 per quarter, is highly secure. This security is anchored by a reported dividend payout ratio of 44.9% for Q3 2025. This metric falls comfortably within the bank's targeted management range of 40% to 50%, confirming adequate earnings coverage even under moderate stress scenarios. The analysis suggests that successful execution of anticipated monetary policy easing could reduce the inherent credit risk and act as a powerful catalyst for a meaningful re-rating of the bank's valuation multiples. The anatomy of earnings: how CIBC generates revenue. The structure of CIBC's financial performance reveals a dual reliance on core, stable net interest income generation from its lending activities, supplemented by cyclical, fee-based revenues that often provide significant, albeit volatile, quarterly boosts. Understanding this composition is central to assessing the sustainability of the bank's profitability. Composition of revenue and net interest income (NII) dynamics. For the third quarter of 2025, CIBC recorded total revenue of $7.254 billion. The bedrock of this revenue structure is non-trading net interest income, NII, which totaled $4.297 billion. This substantial contribution reflects the fundamental business of banking, borrowing at a lower rate and lending at a higher rate, a mechanism that benefits significantly from high prevailing policy rates. The core banking stability is confirmed by the sustained growth trajectory of NII. Non-trading NII expanded by 13% year-over-year. Furthermore, a more comprehensive measure, NII excluding trading activities, grew an impressive 16% year-over-year. This strong expansion demonstrates effective operational execution in a dynamic rate environment. The substantial growth in NII suggests the institution has adeptly managed its asset sensitivity, allowing it to successfully reprice its floating rate assets faster or more favorably than the rise in its funding costs, such as deposit rates. This capacity to expand net interest margin, NIM, underpins the stability of core profitability, making the primary source of earnings highly reliable for covering fixed obligations, notably the dividend. Non-trading non-interest income contributed $2.390 billion, rising 7% year-over-year, providing a healthy layer of revenue derived from fees, service charges, and wealth management activities. Segment performance and growth drivers. CIBC is diversified across 4 primary operating groups, all of which exhibited healthy double-digit net income growth during Q3 2025. The Canadian Personal and Business Banking (CPBB) segment functions as the institutional anchor, contributing $812 million in reported net income, reflecting a strong 17% growth rate year-over-year. Performance in this segment is driven by a combination of factors: sustained volume growth in consumer lending, expansion of loan spreads benefiting from higher rates, and operational improvements. Strategic digital initiatives and a focus on client experience are enhancing performance, demonstrated by the attainment of an Imperial Service Net Promoter Score (NPS) of 74.7, its highest score to date. Canadian commercial banking and wealth management exhibited accelerating momentum, with net income surging 19% year-over-year to $598 million. This acceleration is linked to resiliency in the Canadian commercial loan book, high utilization rates among corporate clients, and robust demand for high-margin advisory and asset management services within the wealth division. The success of this segment is strategically important as it contributes to diversifying fee income and reduces over-reliance on consumer lending. The U.S. Commercial Banking and Wealth Management (USCBWM) segment delivered $254 million in net income, $186 million, achieving a growth rate of 17% year-over-year. This stable double-digit growth trajectory outside of the Canadian domicile serves a critical strategic purpose, functioning as a necessary operational and geographical buffer against domestic concentration risks. The segment's growth demonstrates the successful integration and execution of the bank's North American expansion strategy. The Capital Markets (CM) division recorded the most dramatic financial uplift, with net income soaring 87% year-over-year to $540 million. While impressive, a granular analysis of this growth suggests it must be interpreted with caution regarding its future sustainability. The analysis of revenue components shows that total capital markets net income surged, yet trading revenue specifically registered a 24% decline year-over-year, totaling $567 million. This structural divergence implies that the extraordinary 87% net income growth was powered predominantly by non-trading fees, such as advisory, underwriting, and investment banking fees. These activities are intrinsically linked to the market transaction pipeline and corporate deal flow, making them highly cyclical and prone to rapid reversal should economic or market conditions deteriorate. This introduces a transient element into the segment's contribution to Q3's overall profitability, necessitating a normalized view of the bank's ongoing earnings capacity. Operational efficiency and strategic roadmap. CIBC is demonstrating effective expense management through strategic technology deployment, confirming its ability to generate positive operating leverage. The bank registered a positive operating leverage of 1.9% on a reported basis in Q3 2025. Generating positive operating leverage is an essential metric for institutional investors, indicating that revenue growth is outpacing expense growth, which confirms the scalability of the bank's platform. The institution's strategic initiatives are heavily weighted toward enhancing data and artificial intelligence (AI) capabilities. The goal is to establish enterprise client and product data with robust infrastructure and cross-business connectivity via a single client view. The deployment of AI is already yielding tangible results, with the bank reporting 200,000 hours saved since the launch of its internal CIBC AI platform. This strategic investment is aimed at driving operational efficiency, improving client experiences, and maintaining an industry-leading mobile experience. Capital strength and credit risk management. A deep assessment of CIBC's investment profile requires a rigorous examination of its balance sheet resilience and its ability to absorb economic shocks, particularly those related to its Canadian housing exposure. Regulatory resilience and capital adequacy. CIBC maintains capitalization levels that are robust, comfortably above mandated regulatory minimums, and consistent with top-tier Canadian banks. The Common Equity Tier 1 (CET1), a crucial measure of core capital strength, stood at 13.4% as of July 31, 2025. 1. This measure of capital adequacy ensures the bank is well positioned to weather unexpected losses. Complementary regulatory metrics further affirm its stability, including a Tier 1 ratio of 15.3% and a total capital ratio of 17.6%. 2. The bank's high credit ratings, such as AA2/A+/AA from Moody's, S&P, Fitch, and DBRS, respectively, for its deposit/counterparty debt, 2. Underscore its perception of low counterparty risk within the financial ecosystem. The institution is recognized as a well-capitalized entity among the top 5 Canadian banks. Provisioning for Credit Losses (PCL) Trend Analysis. Credit risk management is a defining feature of the Canadian banking environment. CIBC reported total provisions for credit losses (PCL) of $559 million in Q3 2025, a figure that was $21 million lower compared to the same quarter in the prior year. The reduced PCL expense is a favorable signal regarding the institution's credit outlook. This variance was partially attributed to a modest provision reversal on performing loans. 1. A provision reversal on performing loans is a significant indicator that management's forward-looking macroeconomic models and credit quality assessments for Stage 1 and Stage 2 loans have improved, suggesting that previously modeled credit losses are now deemed less likely to materialize. This decision confirms a stabilization and perhaps marginal improvement in the perceived credit risk outlook among the bank's overall portfolio. The impaired PCL ratio stood at 33 basis points in Q2 2025, reflecting controlled losses in line with the bank's established tolerance. CIBC has also explicitly noted that its impaired PCL ratio is stable quarter over quarter and generally outperforms the peer average loss rate across the industry. This comparative credit health argues against a severe deterioration in its lending standards relative to the broader sector. However, the composition of PCL did reveal shifting pressures. While provisions were lower in the retail and wholesale sectors, this positive development was partially offset by higher provisions specifically recorded in the real estate and construction sector. This shift highlights the continued sensitivity of commercial real estate developers to high borrowing costs and slower transaction velocity. Successful execution of these rate cuts is paramount to reducing the currently perceived credit risk associated with CIBC's domestic balance sheet, dividend safety, and investor income commitment. For income-seeking investors, the commitment and capacity of CIBC to sustain and grow its dividend are critical metrics. The bank's commitment to shareholder returns is evident in both its quantitative metrics and its capital allocation strategy. Sustainability analysis, payout ratio metrics. The common share dividend is currently fixed at $0.97 per quarter. This distribution is highly secure, supported by robust earnings coverage throughout fiscal 2025. The most essential quantitative metric confirming sustainability is the dividend payout ratio. For Q3 2025, the reported dividend payout ratio was 44.9%. This figure is centrally positioned within the bank's stated management target range of 40% to 50%. Operating the payout ratio comfortably within the lower half of the target range provides significant cushion. The strong 17% year-over-year growth in net income, directly reinforces the coverage capacity, providing substantial financial room to absorb anticipated cyclical fluctuations in earnings or unexpected increases in future credit losses while maintaining the current dividend level. The bank's stated target for reported/adjusted diluted EPS growth of 7% to 10% for 2025 suggests that future dividend growth is a probable outcome, provided these earnings targets are consistently met. Capital allocation and shareholder return policy. CIBC's management has demonstrated confidence in its future profitability and capital position through tangible actions. The dividend was increased to $0.97 per share in December 2024, signaling a commitment to a growing distribution and improved earnings quality. A significant indicator of capital strength and management philosophy is the change implemented in the Shareholder Investment Plan (DRIP). Effective January 28, 2025, and for future dividends, CIBC common shares received by participants in the plan will be purchased from the secondary market rather than being issued from Treasury. 10. This strategic shift is a powerful signal to the market. When shares are issued from Treasury, it functions as a mechanism for the bank to accumulate capital, often at the expense of diluting existing shareholders. By moving to secondary market purchases, the bank is confirming that its current capital levels, particularly the 13.4% CET1 ratio, are sufficient and that it no longer needs the DRIP as a tool for perpetual capital accumulation. This change is fundamentally non-dilutive and highly favorable for long-term equity holders, as it confirms that the focus of capital management has decisively shifted toward protecting shareholder value per share rather than prioritizing capital accumulation. Current valuation and peer context. Assessing CIBC's current market valuation necessitates an understanding of its fundamental financial capacity relative to structural risk. While direct real-time PE or PB ratios relative to peers for Q4 2025 are constrained by data availability, a contextual analysis anchored by key operating metrics provides a robust assessment. Fundamental valuation metrics, contextual integration. As of October 2025, CIBC's last 12 months LTM reached $20.4 billion, which generated LTM net income of $5.7 billion. Based on a current market capitalization of $78.7 billion, the resulting enterprise value to revenue multiple on an LTM basis stands at 8.9x. The analytical premise for valuation must acknowledge the operational paradox of the institution. Structurally, given its strong capital base, 13.4% CET1, and its demonstrated earnings momentum, 17% year-over-year net income growth, CIBC intrinsically warrants a valuation multiple consistent with the industry average. However, the market's reluctance to price it accordingly highlights the dominance of risk perception over earnings power. Relative positioning within the Big Six. Comparative analysis of credit quality suggests that CIBC should not be subject to a severe valuation discount solely based on current credit performance. For instance, the bank's credit card 90-day delinquencies and net write-offs are specifically noted as outperforming the peer average. 2. Furthermore, the total bank impaired PCL ratio is reported as stable quarter over quarter and outperforming the average industry loss rate. However, any persistent price-to-earnings or price-to-book discount relative to larger, more geographically diversified Canadian peers, such as Royal Bank of Canada or Toronto-Dominion Bank, is almost entirely attributable to the specific structural risk profile of CIBC. The concentrated, large-scale exposure of $43.6 billion to Canadian condominium mortgages in highly rate-sensitive markets, Toronto and Vancouver, is the undeniable source of this sustained valuation drag. Institutional investors embed a required yield premium or demand a lower entry multiple to account for the heightened, non-diversifiable local credit risk embedded in this portfolio. Forward-looking valuation drivers. The future trajectory of CIBC's valuation is inherently linked to two external factors: monetary policy and internal execution of earnings targets. The most powerful potential re-rating catalyst is the anticipated trajectory of the Bank of Canada's policy rate. The expectation that the overnight rate will be reduced to 2.25% by the fall of 2025-7 is instrumental. As lower rates alleviate the financial stress on Canadian homeowners and stabilize the residential real estate market, the market-perceived risk associated with the bank's large housing exposure will incrementally decline. This reduction in perceived risk should translate directly into a tightening of the valuation gap between CIBC and its peers. Furthermore, sustaining and achieving management's earnings guidance is essential. The bank targets reported/adjusted diluted EPS growth of 7% to 10%. 4. Execution on this target, particularly if accompanied by a continued stabilization or favorable trend in provisions for credit losses, PCL, would confirm the sustainability of profitability and justify an appreciation in the valuation multiple toward the peer average. Macroeconomic backdrop and investment risks. CIBC operates within a complex North American macroeconomic environment defined by stabilizing inflation, evolving trade policies, and monetary policy divergence. Macroeconomic overview. Global equity markets posted strong gains in 2024, influenced significantly by U.S. political dynamics and expectations of pro-business policies, although most non-U.S. equity markets, including Canada, lagged due to threats of tariffs on U.S. imports. 12. Canadian equities demonstrated relative resilience, partly boosted by strength in sectors like technology. Fixed income markets in Canada experienced a unique trajectory. Bond market returns gained over 4% for the year, primarily due to Bank of Canada rate cuts that outpaced those implemented by the U.S. Federal Reserve, the Fed. 12. This divergence in policy reflects differing domestic economic pressures. The near-term economic forecast for Canada suggests moderate growth, with Canadian real gross domestic product, GDP, expected to grow by 1.2% for 2025. 13. Analysts anticipate that slowing labor markets will weigh on wage growth, which is a key driver of services inflation. This deceleration is expected to lead to a decline in headline inflation into 2026. 14. The consensus view is that fiscal policy, coupled with anticipated BOC rate cuts, should support a pickup in growth in 2026. Key investment risks and headwinds. While CIBC's operational performance is currently robust, several external and internal risks could significantly impede its forward performance and valuation multiple expansion. Monetary policy disappointment. The investment thesis hinges on the anticipated relief provided by monetary policy easing, specifically the expected reduction of the Bank of Canada overnight rate to 2.25% by the fall of 2025. 7. If inflation proves to be stickier than expected, potentially fueled by unforeseen catalysts such as renewed supply disruptions or sustained fiscal expansion, 15, the BOC may be forced to postpone or limit the extent of rate cuts. An extension of the higher-for-longer rate environment would intensify the pressure on highly indebted Canadian households and commercial real estate borrowers. This outcome would directly exacerbate CIBC's domestic housing concentration risk, threatening the stability of its credit quality and requiring higher provisions for credit losses than currently forecasted. Geopolitical and trade friction. The reliance on North American economic stability exposes CIBC to geopolitical risks. A severe global trade conflict, particularly involving the introduction of elevated U.S. tariffs on Canadian imports, would represent a substantial downside risk to the Canadian economy. Such trade friction would negatively impact corporate confidence, dampen capital spending, and disrupt investment banking transaction pipelines, thereby reducing the high-margin fee-based revenue that propelled the capital markets segment in Q3 2025. Localized housing correction. The most significant unmitigated structural risk remains the exposure to the Canadian housing market. While national macroeconomic trends may stabilize, a severe localized correction specifically within the over-leveraged condominium markets of Toronto and Vancouver could rapidly trigger impaired loan losses, given the $43.6 billion exposure the bank carries in this segment. Even if the broader economy avoids a recession, targeted regional vulnerability in these markets due to factors like high debt servicing costs or increased vacancies could materialize into meaningful credit events for CIBC. This risk necessitates a perpetual monitoring of regional housing dynamics beyond generalized national data. Conclusions and outlook. CIBC's Q3 2025 results confirm a strong operational trajectory, characterized by double-digit growth in core banking segments, successful NII expansion through effective NIM management, and exceptional capital adequacy metrics, 13.4% CET1 ratio. The bank's common dividend of $0.97 per share is securely covered, substantiated by a reported payout ratio of 44.9%, well within management's prudent range. Furthermore, the strategic shift in the DRI policy confirms management's prioritization of non-dilutive capital management and confidence in future internal capital generation. The primary factor determining CIBC's forward valuation is the extent to which the structural risk imposed by its concentrated Canadian housing portfolio can be alleviated. The anticipated easing of monetary policy by the Bank of Canada in the latter half of 2025 represents the most probable catalyst for a potential reduction in the embedded risk premium. Successful execution of management's 7 to 10% diluted EPS growth target, coupled with favorable outcomes from the expected BOC rate reductions, suggests that the current investment thesis offers a favorable risk-adjusted return for income-focused portfolios, assuming the anticipated rate cuts materialize and avert a severe localized credit downturn. Should policy relief fail to materialize or be delayed, the valuation discount relative to peers is expected to persist or deepen.